Welcome back to the Canadian Real Estate Investor Podcast, everybody. I am Nick Hill, joined always by Daniel Foch. But today we have an esteemed guest who I'm excited to kind of ask some pretty serious questions to and get a real market update from a perspective that most Canadians don't have, but are probably quite curious about. Jacob Cohen, the president of Daniels Corp, one of the biggest and best development companies here in Canada. Jacob, thank you so much for joining us. Tell us a bit about yourself, a bit about Daniels, a bit about what Daniels does in the market, and kind of paint that picture for us before we dive into the questions in the interview here.
Absolutely. Thank you, Nick and Daniel, for having me on the podcast. Appreciate that and the kind introduction. So yeah, as you said, Jacob Cohen, I'm the president of the Daniels Corporation. Daniels is a company that has been around for 42 years. Daniels is a full service development, construction, property management organization that delivers a wide range of housing opportunities in the market. We've been delivering condominiums predominantly for many years, but also townhouse and low-rise development, seniors housing developments, purpose-built rental for probably 15 to 20 years, student residences as well. And our diversity of what we do is really what's kept us going, kept us motivated, kept us excited about the industry, even when times are relatively challenging. So it's been a blessing in that respect that we do have that versatility. In terms of my own upbringing and my career in the business, so like I said, 42 years as a company, I've been at Daniels for 21 of those years. So the only job I had prior to Daniels was teaching tennis over on the island in Toronto. So there wasn't much before that. So it's been development, it's been real estate for definitely a good part of my life. I have a passion for it. I have a passion for working with people, providing leadership, providing guidance to a bunch of our different teammates that are seeing new parts of the industry right now, seeing the industry go through challenging times. I kind of was lucky to be able to be mentored and coached by many great leaders. I'll call them the OGs of our company who were there and predated me and my 21 years. And have really showed a lot of how to work through challenges, how to stay nimble, how to stay diversified in these times. And I think that's really benefiting me and my leadership style and us in these challenging, difficult times.
Yeah, I think difficult times for sure. Go ahead, Dan.
Yeah, no, I was going to say that Nick mentioned kind of before we got in here. I think that like tells me a little bit about like the agility that's required in the market and finding different markets. And, I don't know if we need to belabor the point of how bad the condo market is, right? And I think last time we had you guys on the show, sort of exploring that at its infancy. But no, this article came out a couple of days ago with the title, "These Toronto developers see profit in building for seniors" as an example. And so can you tell me like even just a couple of examples of what agility or nimbleness or finding different niches actually looks like in this market, and how any investor, whether it's a mom and pop maybe looking to buy one single unit or develop something, to massive pension funds perhaps or funding partners that you work and can capitalize on sort of the trend that might create those opportunities.
Yeah, absolutely. Seniors housing has been something that Daniels has been very much interested in and a part of for probably about 20 years. It was something that, we had been thinking about the baby boomer generation, and knowing that the baby boomer generation was going to be getting to a place where they were going to be thinking about downsizing or right sizing and moving to locations that may have made more sense. So over the course of probably about 20 years, we've built just about 15 seniors residences with various partners in the seniors housing space. Now, predominantly that's been with Amica, that has been with Chartwell, that has been in relationships with Welltower as well. But I think, what's important to note about being nimble and being in that space as well is Daniels is a development and a construction management company first and foremost. We do not say that we know how to run a seniors building or the operations of a seniors building, because they're extremely different than a condo, than a rental, than a student residence. They have a lot of different components. And so what I would say is the key is partnering up with people, partnering up with experts in that field who understand how the operations of running a seniors building works. How do the amenities work? How do the food services work? How does the healthcare work? those are all things that there are many very talented industry leaders in the senior sector that are out there right now that I believe are really interested in looking to build more and add more seniors to their portfolio, but more seniors housing to their portfolio. But I think the key with many of them is they don't want to take on much of the development risk and the construction risk that goes along with that. So that's where having a very seasoned and an expert development and construction management group to partner with is where kind of we've found our space in that regard and partnered up in a couple of those great instances.
Yeah, I think, it's so funny. I'm gonna distill that all the way down, because one of the things that we preach on this show, Jacob, is finding your power team, knowing what your skill set is, and going and teaming up with people who have another skill set, whether that be commercial brokering, whether that be quantity surveying, whether that be development or planning or architecture or whatever it may be. And here we have the president of Daniels Corp basically saying the same thing. Hey, look, we know what we're good at. Let us do that, but let's go find people that are good at the management side of it. And, I was out with some other developers yesterday for lunch, and they were saying that, we'd love to get into the seniors game, right? I mean, like the seniors REITs are killing it. The baby boomer stuff is, the numbers are you can't ignore them at this point. They're so obvious that this is where things are going. But you're right, the management side, right, is so much different. It's if you think short-term rental stuff is an active business, try having, healthcare and PSWs and all of this other stuff built in. It's a whole different business. We've seen major slowdowns in the market in some stuff that you guys were, predominantly involved in. Obviously, Daniels does a ton of different stuff. Talk to me about the difference between, and where your concern lies between, the activity slowdown and some of the kind of like price discovery and price decline that we've seen in the market, kind of across all asset classes, obviously with some, getting a lot more hurt than others.
Yeah, I think activity in the construction development sector goes in cycles like anything. So for us at Daniels, last year was an extremely busy delivery year from a condo, from a rental, from a student residence, from a seniors residence perspective. I think all told over those programs, we had about 3,500 units that were delivered over the course of 2024 into 2025. That was in a very busy time, but what does that mean? That means the construction teams that are working on those programs are fever pitched, they're going like crazy, the trades are crazy, and all that is really at a high level. What's happened now in 2026 and is moving towards 2027 is those guys on the back end who are busy finishing those jobs are now coming to an end, and it's the construction guys and construction gals and the teams there that are not feeling that same fever pitch of what they did kind of through that earlier time frame. So what I would say right now is we're seeing a slowdown at Daniels kind of more on the back end, the finishing side of things. But where we are seeing now is that uptick in the development side, in the planning and approval side. Our contracts and estimating team at this point are doing so much budget analysis and budget reviews and working with partners to try to get better budget pricing for the projects that are going to be starting at the tail end of 26 and into 27. And so really busy kind of on the front end stuff, while our construction guys sit in there and wait and say, okay, Jake, when's the next job? I'm ready to start. So, it is that cyclical sort of cycle thing that we are working our way through and making sure that the pipeline is full so that we can keep those very talented people going and doing what we do best, which is deliver and building different types of housing typologies.
Yeah, I mean, over 42 years in the business and 21 for yourself, this obviously isn't the first cycle that you've seen. It might be the most aggressive or a very different looking one, but definitely not the first, and probably won't be the last if you spend another couple decades there, which it sounds like you will. I want to zoom in on something you said there, keeping those highly skilled construction guys and girls active, engaged. Let's talk about that for a second, because and you probably have more visibility to this than most, right? We talk about the baby boomers, we talk about seniors housing, but there's something else attached to that as well. And that's kind of the silver tsunami of a lot of those people that are either almost baby boomers or baby boomers that are skilled tradespeople that are going to be retiring in the next 2, 5, 10 years. What is Daniels doing, or what do you see the market doing, you and your peers in the market, What are you doing to circumvent that, to deal with it, to prepare for that? Because I feel like that is kind of the next, big speed bump or hurdle that the development community is going to have to deal with.
It's a very real factor. There is no question about that. There is a generation of trades and tradespeople within the companies that have been delivering housing in the GTA for 35, 40 plus years that are exactly that, getting to that point in time where they need to kind of move to the next generation and move it along and ensure that their companies are set up for success. So what Daniels is doing, and we have been doing for about 10 years, so we've been ensuring that the trades that we are working with, the trades that we've been engaged with, have succession plans. So it's one thing for us to have succession plans and ensure that we know who the leadership team is going to be for our company going forward. But our company only functions if the trades around us and the groups that we're working with have very strong and talented people working with them. So it's being very open and transparent in terms of, tell us about how your team is going to function in 5 to 10 years from now. That's something you probably wouldn't think about doing or having thought about doing. That's your business. That's not my business. I shouldn't worry about your business. Well, trade X, trade Y, your business directly impacts how successful I can be and how I can deliver housing for various typologies and various groups. So really being mindful and being deliberate about talking about the future, talking about leadership, talking about work and how they're going to replace some of the very skilled foremen and key people that are on the sites that are instrumental to delivering these homes, and having those very deliberate conversations with the 5 to 7 key trades that drive the program. So it's something that you got to be very active in doing. You have to have long-standing relationships. And if you don't have that, start making them and start finding out who's going to be there in the long term.
Yeah,
I think this is like is one of the things we think a lot about. We just did an episode on the Altus construction cost guide, and I don't know if it'll come out before or after this one, but I think BuildForce estimates a huge amount of people. There's the demographic trend. Like, you're obviously capitalizing it on the demand side, but it becomes interesting on the supply side when you evaluate it as well. And it's good to hear that you're paying attention to it. The other, I think, in the going back to the seniors thing, and I think it's an interesting evaluation. A lot of seniors struggle with downsizing. They find it's hard to find a viable ownership option, and so you're actually seeing more kind of pivot maybe into rental seniors apartments. You mentioned that you're creating. They kind of want to get off the maze of owning something and free up as much cash as possible for their retirement. But you're starting to see, I think, a lot of people who were in the condo pipeline before start to pivot to purpose-built rental at this point in time. And I know Daniels has been in this space for a really long time. How much do you, of the current, obsession with this pivot to purpose-built rental is real conviction, or it's necessity and it's people, scrambling to try and get their feet on the ground to salvage a project otherwise wouldn't work? Or is it, is it really just a very clear indication that condo is not working anymore?
Yeah, I think it's a combination of a bunch of those things, Daniel. I think it's condo is absolutely not working, and everyone kind of knows that. And so many developers can say, okay, I'm okay to sit on my hands and do absolutely nothing. And many are doing that, and maybe they can wait it out. Others are saying, we can't wait it out, and we got to do something different. And that pivot to rental, when maybe there's not that expertise or that understanding that it's very different than in condo environment, that the operations, the maintenance, the staffing model, how to run a rental building professionally, the lease up, the turnover. There's so many factors that go into actually how to run a rental building and be successful with it that I think that is not totally understood quite yet with many who are making that pivot and making that transition. And then the other thing is the financial side of it. The amount of equity required to stay in and be in there for a longer term on a purpose-built rental environment is significant. And that will restrict a lot of people from even making that pivot turn it into a reality. They just won't be willing or want to be willing to do that, or their investors won't be willing to be in it for that long term without a direct, clear path to an exit. That's what I think every condo developer always had in the boom of the times. There was a very clear path to an exit for investors, for getting money in, getting money out. That is very different now. That is a longer term horizon, and unless you're willing to move into the rental space with patience and have that long-term view of it, be able to have an operational management of the building in a way that's extremely professional, that's going to ensure that it's going to create the value at the end of the day, that's the only way it's going to work for many of these people who are doing that pivot. And yeah, we're very bullish on it because, again, we see the back end, we see the back half of how it actually works and how it works to translate and what turnover looks like and how to replace that. And that's an important thing for us. But we are hearing much of the, let's just jump in and see what happens. And I think that is a dangerous place for a lot of people.
Yeah, I completely agree. I think that space, the purpose-built rental space, has opened it up to so many more types. We have the new term citizen developer, right? This is not someone that's competing with Daniels, obviously, but it's someone that still holds the title of developer. And, there's so many people that will go and try this, but as you said, this is so much more than just building. This is the management part of it as well. And, we've said this on the show a million times, tenants are the real asset, right? You can go and build the best product. You put the wrong people in it, it starts to fall apart pretty quickly. So, we've seen this, condos fall off a cliff, single family homes be steady, but, almost a flat line over the past several years, and a massive hockey stick chart up to the right for purpose-built rentals, which is great. We're getting something built. It might not be what Canadians apparently want or traditionally have wanted or are used to, but I want to throw this one out to you, Jacob, and hear your thoughts on it. If I were to say, Canada's moving towards more of a renter's economy, what kind of response did that trigger for you and the people that you work with and your investors and the people that are moving into your places, et cetera? What does that mean?
Yeah, I think there's a reality to how financially challenged it is for people out there right now, especially to get into home ownership. And so the notion of a renter's economy to me means, yeah, if you are, trying to enter the market from a condo or from just an ownership perspective, it's way more difficult. The amount of equity required is challenged. People are just maybe not making as much as they were. The industry in general is softening. And so I think having a renter's market is an okay place to be for a time. I think home ownership will continue and will have a place for the GTA and for Canada going forward and into the future. There will be a place for home ownership because people are going to want to own something. And I think ownership is an important factor. I think just it will take time now to work ourselves back up to that point in time. And a lot of that is happening naturally now by costs are coming down. Like the rising amount of cost that it was to buy a condo in downtown Toronto got to astronomical numbers. It was not sustainable. We don't need to go back and dwell on all of that, but it's getting back to a place that might be more achievable. There are other factors at play that are starting to help too. Government policy, government approaches, stimulation, HST rebates that are allowing people to get back in and get 13% off the purchase price. That's a meaningful amount of money for people that allows somebody who had an equity amount to be able to perhaps get into that 1 bedroom or 1+ den, or maybe even a 2 bedroom if there's 2 people. So renter's economy for sure, it's going to be like that for the next 18 to 24 months, no question, but there will be a place for the condo market to return.
Yeah, I completely agree. I know you said you listened to the show a little bit. I wonder if you heard the episode that the first-time home buyer is now how many years old, Jacob? Do you know this?
No, I can't remember. I didn't hear that
40,
part.
40 years old.
40.
In
Well,
Ontario,
I mean,
in Ontario it's 40.
Yeah.
it makes total sense. I mean, like, unless you're getting significant help from certain places, the ability to save enough money to buy a home is really challenged in the GTA and in maybe the downtown. And that's a problem. And that will start to be addressed as we see some of these pricing numbers come down.
Yeah, so you mentioned kind of like the return of the condo, right? Obviously, the condo is not. It's not like we're never going to see another condo built in this country. Right? Let's be real. Of course, we are. It was center stage for quite some years, got a little out of control, and I think it got out of control for a number of different reasons, right? Kind of what the ridiculousness of trading paper and stuff like that really kind of fueled the fire. Talk to me about what the return of the condo might look like. We're not going to hold you to this, but when, how, where, what type of product that we're going to see, right? Is it going to be the stuff that we know, like, the thousands of studio apartments that are, in the sky kind of thing? What does that look like to you in the next couple of years?
Yeah, a couple of factors that we are leaning into. Its size and its scale. And I think we are very much of the belief that the right size and right sizing for neighborhoods is extremely important. So, maybe you could go and get density and get a tower that's 70 stories high, but does that actually make sense for the neighborhood? And in our minds, that does not. It's got to be the right size and the right scale, and forget what your pro forma says on paper, what makes sense for the neighborhood and where you need to be building. And if it doesn't make sense for that, don't go buy that piece of land to try to go and create another monster tower. So I think gone are the days of the monster towers and the 700 plus unit programs. I think that will not be coming back anytime soon because I don't think it's viable anymore. I think what is coming back and what we are leaning into, at least in the immediate, in the interim, is we're building more low-rise housing, stick-built, townhouse, family-oriented housing in suburban locations, not necessarily downtown Toronto, but suburban locations, Ajax, Oshawa, Pickering over on the east side, in the Durham area, and then Brampton, Mississauga, Erin Mills, 2-story, 2 and 3-story with a backyard, with a car parking, sometimes with a finished basement, places where families can live. Multi-generational living, I think, is really important. Like we just mentioned, if you can't buy your first home till you're 40, what's the opportunities that you might have? Well, you might buy with a friend, with a family member, have a grandparent live downstairs in a nanny suite or something like that. So we're leaning into more low-rise built forms in the immediacy. And then we're leaning into, in from a condo perspective, 8 to 12-story programs, right-sized buildings, 200 to 250 units. I'm not going to call them boutique by any stretch. They're still significant buildings with decent amenities but a bit more back to basics in terms of an approach. And I think that's the type of condo programs that will be successful going forward. And at least those are the ones that we are going to lean into and find the neighborhoods on those outskirts that make sense for that.
Yeah.
Developers love, sorry, Dan, developers love throwing around the word boutique, right? Boutique, and you get to toss on a couple extra bucks to the sale price, I guess, right?
Yeah.
I think, we did an episode with CD Howe. They recently did some research on how Canadians want the things that you're describing, right? Nobody really asked for, massive towers with hotel room size suites in them, like other than maybe investors. And that got us a lot of housing created, but we obviously have a pretty clear supply demand mismatch in the type of unit, even if the number is fine. But the other thing that you mentioned kind of at the beginning of your last answer was the project economics. And so you're, kind of going more towards stick frame, ground base, smaller building configurations. Can you walk me through, like, for our listeners, the project economics? Like, what makes a project viable? What has to be true in underwriting for a project to actually pencil right now? And then which inputs are broken or the ones that are most obstructive to making that possible for you?
Yeah, for sure. Absolutely. So I think predominantly what works and what's going to work in the immediacy is going to be IRR driven. And again, we won't get into the technical aspects of IRR.
We love a good IRR for sure.
Okay, you guys do fine. Yeah. But what goes into it is the speed. Let's break it down. The speed in which you can get in and get out and deliver a housing typology. And so right now, if you can deliver 100 townhouses in 16 to 18 months from a construction perspective, that is what's going to pencil. The duration of money in to money out instead of a 36 or a 46 month program on a significant tower program that just takes that much longer. That's the direct impact on the IRR. And that's where a lot of the money is going to come from when institutional capital is looking for that, is looking to kind of maximize that IRR and make sure that it's going to work. So I think that's one input. So speed and scale of delivery is going to be hugely important to make it pencil. Construction trade pricing is going to continue to be a factor. And I think we talked about it earlier in that, there's continuing to be a slowdown on the back half of the trades. There is not as many starts that are taking place. Trades are getting hungrier to want to work. So pricing is continuing to be driven down. So where we were carrying pro forma numbers of $475 a square foot for hard costs, we can drive that number down to below $400 a square foot in hard costs. And that's starting to make a very real difference. That's going to start to help make it pencil more. Thinking about things like parking. How much parking do we actually need? Do we need to go 4 levels of underground? I sure hope not. That is extremely costly. It's extremely time consuming. What are ways that we can go about finding sites to allow us to go to 1 level of parking, above grade parking, creating designs, concepts that allow us to avoid doing those sort of things, to again, try to help the IRR, try to help the duration in which we are in, or an investor is in, and then they are out. And I think that's what we're going to see is what's going to make the difference for a lot of the projects that will work or will not work going forward.
Yeah, I think that's super important. I want to, timing in real estate can be your best friend or your worst enemy, right? A project is supposed to take 16 months. It takes 24. Bond yields might have changed. Your IRR disappears. Policy might have changed in that time period, right? It's so hard to pencil in the unknown. Jacob, I wonder if you can so I'm a commercial mortgage broker, and of course, obviously, after this interview, all of Daniel's business is going to flow through me, which is going to be great. So, talk to me about some of the financing challenges that Daniel's itself, or just that maybe you're seeing your peers in the industry go through it. From my perspective, financing is a lot tighter these days. People want to see more. I'm working on anything from like a 5-unit construction project to 150, 300 unit builds kind of thing, and it's harder to get financing. The CMHC wants to see more. Lenders want to see more. And that's usually the first thing that can kill a project, right? Because you don't think, okay, it went from 12 months to 16 months. Okay, well, for most people, that's just another 4 months. But for us, we understand that's 4 more months of carrying costs, your interest costs.
Killer.
So talk to me about the challenges there.
It's about having a discipline around the delivery of what you are doing. And you cannot let projects slide in that respect. And we learned a lot of that in building in Regent Park for about 15, 20 years, working for Toronto Community Housing and delivering affordable housing for them for over that duration. You would have to set a budget, you'd have to set a schedule, and you have to hit that schedule because a lot of the times there were tenants that had been moved out of their homes, relocated, and needed to be moved back in. Yeah. So, developing a level of discipline around the execution of construction is hugely important to ensuring that you're going to be able to get the appropriate financing that you need from the banks that are going to be players, at the tables. I mean, at Daniels, we have delivered that time and again for our construction lenders, in that we have demonstrated if we say it's going to be 18 months for a townhouse program, it's going to be 18 months for a townhouse program. Again, stuff comes up, things do happen from time to time, but having that history of being able to deliver, pay back our construction loans, ensuring that we're there when we say we're going to be there, allows us to have conversations with the majority of the Sked A banks to say, our plan is a condo building, a purpose-built rental, a seniors building that's on our books, that we're going to have a forward purchase at the end of the day. But the key is then, how do you deliver that and not let it burn and take up all the time? And that comes down to construction discipline and making sure you have the good construction in-house expertise to drive these programs to get them to the finish line. You put the financing in place, that's great, that's cool, fantastic. You let it slide, or you let construction slide, it all can go out the window very quickly. So I would say a level of discipline around the CM work, around the delivery side of the business, is what helps unlock much of the financing that many people are having challenges with right now.
Yeah, I think, when you discuss like sort of the potential for supply to drop off, whether or not purpose-built rental is going to backfill that, would like an outcome of a supply crunch, if we end up in an excess demand scenario as immigration comes back in 2028, et cetera, like would that actually help builders who are left standing after maybe a period of Darwinism takes place, and then is that, like, just trying to analyze economic incentives here, like is that part of your incentive structure to say, yeah, we want to be the ones who are still delivering despite during that period of time, protecting the brand, not stepping back, not failing to deliver or writing down projects or whatever, while a lot of the other participants in the industry are on pause or just, struggling to stay alive.
Yeah, we've leaned into that starting in 2023 when the tap turned off. So 2023 kind of probably when you last talked to Dominic, our VP of sales at Daniels Realty, was when our last condo sale went on the market pretty much. As soon as that happened and the tap turned off and we recognized that, we said, okay, there are options. You can sit and do nothing and wait, or how do we keep moving the machine forward in various different and creative ways? And so that's exactly what we've done. It's understanding that there's maybe more risk in doing so, but also understanding that if we have a 100-unit townhouse program in Brampton that we can deliver in 18 months and deliver it in, end of this year or into 2027, and then start another one that we are starting right now and deliver it in 27, 28, and 29, there's going to be a gap in supply at that point in time. And we want to lean into that gap. We want to ensure that we are still here delivering into that gap because we know it will be there because people have not been as active. They have not been as direct in saying, we know we can continue to move forward in different typologies. And I guess that does come back to just our nimbleness as a company and our diversity in what we deliver. And I totally get that. If you've never delivered townhouse or smaller style buildings in the past, you wouldn't necessarily want to jump into that for the first time. But it's something that we believe very strongly in. And it's kind of led us to starting a number of programs this year and will be into next year so that we are delivering into 28 and 29.
Yeah, I think it's such an important piece. I once had a developer tell me that, he did really well during the kind of boom times. And then when it was a bit more of a bust, he was barely making any money, but he kept all of his trades employed. He kind of kept everyone working. It was almost kind of make work stuff a little bit, but he watched all of his competition lay people off, office staff, site staff, etc. And then, of course, when the good times came back around in a couple of years, those competitors tried to go and hire people and, restart the engines. But, this is a big machine to restart. So I think there's a lot of merit in being able to kind of make it through the grind and really even excel when times are harder. And I want to kind of distill that down for our listeners who, aren't building condo towers, but are trying to maybe build their first multiplex or even go and buy their first investment property. Just because the times are tough doesn't mean that you pause or walk away. It means that you adapt and kind of lean into the changing market conditions, right? I mean, things are only going to be like this for so long, then they're going to be another way for a little bit, then they're going to be another way for a little bit, right? I mean, Jacob, we've talked about cycles multiple times in the last 30-something minutes already. It comes and goes. So I just wanted to take what you said and kind of distill that down for anyone trying to do anything in this market. Now, speaking of the market, I'd love, obviously you're a very sharp guy. You're surrounded by people that do this day in and day out. I'm sure you talk to your peers in the industry. High level, walk me through how you see from like now to 2030 going, right? A lot of people that I talk to, Dan and I talk about on the show, we're kind of grinding along the bottom right now. Maybe we've hit bottom. Maybe we're on the way up. Maybe it's going to be a slow grind over the next 2 years. Interest rates, inflation, immigration, all the buzzwords, purpose-built rentals, condos. Where do you see the industry and the overall market going? Time for a bit of a prediction. No crystal ball, I know, but where do you see things going? Where does Daniel see things going between now and 2030?
Yeah, I think there's going to be more money that becomes available from the various levels of government that are going to help stimulate various types of builds. Whether that's incentives for people to build more rental housing, which is kind of happening now, which we hear about, and we're seeing many people trying to take advantage of DCs and property tax waivers and a number of things there that are helping stimulate. So I think that's going to continue. It's got to continue. I think there's going to be more money available for affordable housing plays, and that's something we're very focused on right now. The government needs to build more housing. The government can't build it themselves. I think that's the truth of it. They will need the private sector to build more housing and more affordable housing. So how do we position ourselves and how are we positioning ourselves? Well, we're positioning ourselves in a way where there are lots of agencies and groups out there that are going to have access to that funding. The funding and the money is not coming to the developer. The funding and the money to build affordable housing is going to go to the public agencies, the public bodies that need to be the ones that are administering affordable housing in the city of Toronto and the greater GTA. But they need executors to do that. These agencies don't know how to build housing. They don't know, like the government, they can't build it themselves. They're going to need groups to do it for them, need groups to help them through a development process, help them through the planning, the design, the construction, and then the delivery at the end of the day. There's going to be a lot of opportunities that we are already seeing and that we're looking to be part of with a number of these groups right now, currently, that we're going to be starting to build this year and next year in that space. And that's a space that I think others are going to get into as well and should get into, because that type of housing is absolutely needed. Then I would say there's going to be the condo space. The condo space, I think, will come back come 2028. That's kind of where, if I'm crystal balling, when my sales guys are saying, when are we going to sell again, Jake? We're talking about 2028 in terms of a program. And that program is, how do we make it as basic, as back to basics? What are the necessities of that site that are needed? How can we drive the lowest possible price per square foot from a sales perspective, but still come out with our shirt? That will be the key. I'm not looking to make huge profits. That's not the goal for 2028 sales launch. It's how do we make a building work? How do we make it pencil? And that is tightening all the budget numbers, tightening all the consultants to make the design make sense and not be kind of crazy and going for insane roof details and crazy amenity spaces. Simplify those things, drive a good, efficient program so that we can drive a good, efficient purchase price. That's what's going to come back in 2028. That will be the first condo launches that will be successful when they can do that and hit a number, a price point that people all of a sudden are like, oh yeah, okay, this does make sense. I'm 40. I've been saving money. I'm ready to buy. Time for me to get in. So I see that happening. The final one is going to be seniors. Seniors housing will continue to kind of move. We've got a number of seniors projects that will be underway, that are underway now, will be going forward. There's going to be more groups that I think are going to find good seniors housing operators that they can partner with, because I think that is going to be a great industry to be in 28 and 29 and 30, as again, we head into that market. So I think, I'm not going to say we've totally bottomed out. Who knows where it's going to go, but I'm feeling more optimistic than I think I have in a very long time, that we're going to work through many of the challenges of inventory that's been sitting out there for a very long time. And we're going to get to a point where we're going to be able to move into that next cycle.
Great answer. Great insights.
On that note, like for people who are interested in investing in real estate, understanding that not just our audience, but also, the largest audience of people is mom and pop, retail investor, people with, maybe they're looking to buy their first or second property and scale a portfolio from there. What advice do you have for people when it relates to the market cycle, when it relates to, things that they should be doing today to make sure that they're able to actually create wealth within the real estate asset class over the next 2 years, 5 years, 10 years, wherever you want to place it?
Be discerning. Now's the time to be discerning. Like you can have choice out there now that you never had before, and go find that deal. There are deals to be had out there for the investor, for the mom and pop, for the new buyer, to go walk into a developer's office or sales office and see what they have and ask for it for less. People are entertaining, developers are entertaining many, low numbers. They're selling bulk for astronomically low numbers to foreign investor or, buyers who are trying to buy kind of at the bottom of the barrel. If you're a mom and pop, if you're a new time buyer, go in there, find something that you like and drive a deal, because at the end of the day, the developer, and the builder, they need to sell much of this product, and you're going to be able to find something that's out there that will have value if you can get it at a really sharp number. So we know that's happening. We're playing that game. We're trying to move through product that we have from the previous iteration of programs, and we're there to negotiate. We're there to talk to people. We're there to say, what are you looking for? What do you have? Here's what we can offer you. And I think people should be doing that across the board. That is going to help stimulate the economy in the new buy section as well.
Yeah.
Yeah.
Let's get some negotiations going. I love it. It's great advice. Jacob, I want to thank you so much for gracing us with your time and your insights today. I think it's always awesome when we're able to speak to someone with your perspective that's doing really big things here in Canada's major city and, which obviously kind of ripples across the country. I think one of the coolest things is hearing a lot of the stuff you're saying and being able to extract it and distill it down for someone that is really doing things on a much smaller scale, whether it be buying their first duplex, building their first 5-unit building in the city of Toronto or anywhere across the country. The rules don't change, the scale does. It was awesome. If anyone wants to get a hold of you or maybe wants an internship at Daniels or is maybe trying to negotiate one of your pre-cons or something like that for less money, which you just opened up to, how can people get a hold of you? Or if people want to continue the conversation, what would be the best way to get a hold of you?
Yeah, the best way, I'm now way more active on LinkedIn than I've ever been before because that's what my team says must happen. So I'm starting to lean into that. They can find me on LinkedIn and happy to respond to anyone who reaches out about any topic for sure.
There you go. Your newest LinkedIn influencer, Jacob Cohen. Thank you so much for joining us and we'll talk to you soon.
Thanks a lot for having me, both of you.